Insurance industry. Introduction. Insurance in its pure form is a social good and in a number of cases can be classified as a public good, that is, it generates desirable externalities. Insurance companies, mutuals and cooperatives enable individuals and firms to protect themselves against infrequent but extreme losses at a cost which is small compared to the feared loss. They do this through the workings of the law of large numbers and the central limit theorem, which ensures that a sufficiently large number of reasonably homogeneous risks will produce well-behaved and highly predictable aggregate results following a roughly Gaussian loss distribution. Life insurance contracts can be for short periods, for example, accidental death, or very long periods, for example, the whole of life. In consequence, life insurance can intrinsically include a savings element, and in many late transition and industrial countries this component dominates funds flows in the sector. This flow of funds effect can be exaggerated by the fact that in recent decades the life insurance sector has begun to compete directly with mutual funds and unit trusts through unit-linked contracts offering a life insurance tax wrapper. Non-life insurance contracts, which insure material and financial risks, typically run for 1 year and are renewed on the basis of updated risk information. Given its fundamental role in spreading risk, it is not surprising that references to insurance can be found in antiquity. A form of risk-sharing for marine ventures known as bottomry, not unlike modern catastrophe bonds in concept, was in existence more than 2 millennia ago. Non-life insurance in its modern form, also known as property and casualty or P&C, and general insurance, became established in Italian cities such as Genoa in the 14th century to support their active marine-based trading activities, with the first regulation appearing in 1336. The concept spread rapidly to other parts of Europe and eventually to the New World. Life insurance goes back to at least Roman times when funeral societies became popular. Various forms of insurance have been banned from time to time for religious reasons. For example, fire insurance was shunned in southern Germany for a period because it was seen as prevented God from exercising his displeasure, and because of fraudulent or morally questionable schemes such as tontines and pyramid arrangements. The growth of the sector was most rapid in the United Kingdom, largely because of a long-standing liberal approach to markets, and the UK remains the most insured country in the world. However, the modern approach to the prudential regulation of the insurance sector was largely pioneered in the United States in the 19th century, and in Massachusetts in particular. Insurance by its nature is an intangible good, involving payment in advance for an unknowable quality of delivery in the future. Thus trust is a critical element, and public good classes such as health, disability and workplace injury or illness have to date often been delivered through state entities. However, most classes of insurance are usually delivered through private markets, and insurance regulation tends to reflect solvency concerns and information asymmetry between suppliers and policyholders. Many countries have an explicit reference to insurance contracts in their civil codes and specialized laws including specific provisions for retail markets. As fiscal pressures mount, there is an increasing trend to entrust more social good classes, such as workmen's compensation and annuities, to the private sector, and this adds to the pressure for effective market conduct and prudential regimes. Government intervention to enforce mandatory insurance, most commonly motor third-party, workmen's compensation and constructors' all-risk, aside. Private insurance markets form naturally when risk aversion ensures that individuals will pay more than the expected loss in order to hedge against the possibility of a loss that is large relative to available resources. The reason that the market premium is greater than the expected loss is that the expenses of running the business need to be factored in, together with the cost of the capital set aside to underwrite the risks involved. Typically, the market premium is not greatly in excess of the expected loss for most common classes such as motor collision insurance, where claims are relatively frequent, around 11 to 15% annually. and the average claim size is small, thus generating statistically credible databases. However, the cost of capital can dominate where large elements of uncertainty exist and systemic events can affect many risks at once, such as credit insurance and natural disasters coverage. A major industry subset, the global reinsurance sector, has largely arisen from its ability to modify the frequency and claims profile of a direct insurer at a price that is efficient for both parties, that is, reinsurers are insurers of insurers. For a typical mature non-life insurer in an industrial country, the net cost of reinsurance in a normal year accounts for approximately 8% of gross premium revenues. However, reinsurers also effectively lend capital to rapidly growing insurers, both life and non-life, and sometimes known as surplus relief reinsurance, and the proportion reinsured can be much larger in emerging markets. The reinsurance sector has also been the core source of technology transfer between developed and developing markets. Given the balance sheet risks involved, the capital management of insurers bears some resemblance to that of banks. In both cases, it ideally reflects a desire to set some upper limit on the probability of failure within a defined period of time. Hence, elements such as market, credit and operational risk are increasingly reflected in solvency regimes as various countries introduce risk-based supervisory regimes. However, insurance capital determination is considerably more complex as both sides of the balance sheet are stochastic in nature. Liabilities are the present values of uncertain future obligations, and the correlations between liability and asset risks can be much less obvious than for banks. Role of government in insurance. The government has three roles in insurance. The first is to ensure that those who are granted licenses are competent to enter the business and will have sufficient scale. The second is to ensure that there are sufficient competitors to prevent cartels from developing while limiting numbers to a level that prevents pyramid structures, known as cash flow underwriting, from emerging. Insurers are prone to pyramid structures because premiums are paid well in advance of claims and the ultimate cost of claims is uncertain. The main tools to achieve these potentially conflicting objectives are minimum capital requirements, licensing rules and centralized claims data collection so that indicative pure premiums, that is, expected losses per unit of coverage, can be published. Market premiums are pure premiums loaded for expenses and cost of supporting capital. The third role is to protect the public. This is not the same as preventing insurer insolvency. In fact, allowing an insurer in trouble to delay insolvency, known as regulatory forbearance, can be inimical to the public interest and involve substantial unexpected and unnecessary public expenditures. This recognition has contributed to the development of risk-based supervisory approaches, including corrective actions and enforcement based on the ratio of actual capital to statutory measures of risk-based capital. Profile of the modern insurance sector. Today, the insurance sector is a major global industry covering a huge range of risks ranging from natural disasters and environmental hazard, through life and disability and standard property risks, fire, explosion, burglary, and so forth, to various types of liability under tort and civil code to protecting the balance sheets of credit-granting institutions. In the latter case, the sector has developed overlaps with, and become the backstop for significant sections of the banking and shadow banking sectors. It is also a significant source of investment funds. In 2003, 7 insurers were in the top 50 corporations in the world in terms of revenues, and insurers accounted for 2 of the top 4 global financial institutions by market capitalization. The industry is global by nature as it is in the risk-spreading business, but in practice, less than 15 insurers can be called genuine global players. Please follow the table. Table 1. Geographical emphasis of transnational insurers, % revenues. And these are mostly European, with the balance having more of a regional approach or being confined to their home countries. In terms of geographical involvement, it is clear that colonial pasts and cultural affiliations have played a large part in foreign investment. In addition to proximity, Table 1. However, other factors are also important. Of particular note is the fact that, the global success of the sector notwithstanding, there is a massive dichotomy between developed and developing markets. The density of insurance, that is, premium per capita, in an industrial country like France at £3,160 is many multiples of the £38.40 reported by a poor country like India. In parts of Africa, the sector is effectively non-existent, despite its fundamental social and economic role. The insurance development path is discussed in detail below but can in part be explained by the sequencing of the introduction of the various classes of insurance, Table 2, which in turn follow developments in the real sector and the establishment of property rights. The major challenge for development institutions is to work to change the traditional development patterns to support real sector development and hence generate more rapid sectorial development in a virtuous cycle. Please follow the table. Table 2. Sequencing of classes of insurance, % of written premiums by major class. Development paths for the insurance sector. The growth of insurance markets has been different from that of banking sectors, with the insurance sector being more sensitive to fundamental real sector development, and in particular to average income levels. This partly reflects the fact that insurers are usually not allowed to borrow or take on net foreign exchange exposures. Their balance sheet leverage, typically around 10-to-1 for life and 5-to-1 or less for non-life, is naturally generated by the need to hold reserves against claims incurred but not yet settled and future obligations. Thus insurers are more dependent on local financial resource mobilization and in turn on growth in domestic economic activity. Formal life insurance markets normally develop well after non-life insurance markets. This reflects the former's dependence on the emergence of a middle class and, ideally, the development of reasonably deep and liquid capital markets. However, culture can play a part, with life markets appearing sooner where strong savings ethics apply, such as in North Asia and former British colonies. If non-life premiums or capita, premium density, is graphed against GDP or capita, it can be seen that economic growth is the main driver. Figure 1, with a global elasticity between premium or capita and GDP capita of approximately 1.3. However, densities vary considerably between countries at similar stages of development. Please follow the chart. The mechanisms of non-life insurance growth have varied both over time and according to country context. Originally, most non-marine insurers started as mutual organizations set up to meet a common need or out of natural linkages. State Farm, now one of the largest insurers in the world, began life as a mutual to insure farmers' vehicles. Fire insurance was founded in France by the water company, which organized the first fire brigade service. The life insurance industry grew out of widows' funds and arrangements set up by various religious groups, and subsequently by the fraternal movements, supported by industrialization and increasing population concentration. Many large and long-established life insurers in industrial countries had mutual structures until relatively recently, when competition and the obvious existence of lazy capital, and the chance for current management to utilize the profits created over many decades of operations, forced to move to shareholder structures. The current pattern in developing markets tends to be different. Transport, MAT, industrial and commercial non-life lines first appear, driven by the requirements of trading partners and foreign investors/partners and the arrival of international insurance brokers. Even the most extreme centrally planned economies require marine and transport insurance. In addition, certain economic sectors, such as agriculture, often see the early emergence of insurance mechanisms for consumption smoothing purposes. Such classes are often subsidized by the state. However, the general public usually remains unexposed to insurance until motor car fleets begin to build, often with a sudden increase in traffic-related deaths and injuries, at which point compulsory third-party liability insurance is almost inevitably introduced by law. Because of the strong cash flows generated by this class, it often attracts questionable entrepreneurs, and the insurance sector can rapidly lose the public's confidence. Thereafter, the main driver tends to be the development of formal credit markets with attendant needs to cover loss of a wage earner's life or loss of collateral. This helps to explain the strong link to GDP growth and an observed nexus with the development of credit markets. Life insurance-based savings develop along a somewhat different path. Salespeople offering hard currency contracts arrive on the scene as soon as a middle class with surplus income begins to appear. The insurers are often from other countries and the transactions are carried out in hotel rooms. Local life insurers usually cannot be sustained until a reasonable level of income is attained by a significant number of families. The local regulatory system has been strengthened and there is at least some local currency capital market development. Thereafter it tends to grow rapidly, with a premium density elasticity to GDP/capita growth of approximately 2 times. Often the first stage will involve some variant of multi-level selling, that is, using social contacts, and professional sales channels follow sometime later. However, bancassurance, in one of its various forms, is increasingly being tried at the early stages in emerging markets, with varying degrees of success. Thus, while life insurance development is also primarily driven by GDP/capita, there are strong threshold effects, and other factors such as income distribution, the role of social transfers and religious mores can have a significant impact. Figure 2. Recent history also plays a role, with a well-known international brand being seen as a positive in some countries, particularly those of the former Soviet Union, which saw savings destroyed by hyperinflation, and other countries where pyramid schemes have collapsed. Aside from these factors, the major determinant of life insurance development is the level of involvement the sector has in managing funded pension arrangements. There is evidence for a substitution effect when mandatory second-pillar pensions are introduced in more developed countries, although forced savings in poorer countries does appear to lead to a net increase in overall savings. Little work has been done on the trade-offs between establishing local insurers and introducing foreign players, although UNCTAD has encouraged the development of locally owned sectors. The main official drivers of this policy stance usually involve retention of foreign exchange, creation of a competitive domestic market, and local control of long-term funds. The economic justifications behind the second and third drivers can be questioned. FDI has no apparent relationship to market size, but it does appear to be related to non-life underwriting capacity and product or distribution innovation, and foreign insurers tend to be less driven by local bank funding needs and issues of government paper. The retention of foreign exchange argument may be more sustainable provided the mechanism adopted efficiently uses local capacity. For example, a more efficient use of local financial and human resource capacity is sometimes achieved through mandatory reinsurance through a local or regional reinsurer. Such entities enable a more attractive and larger portfolio to be offered to international risk transfer markets and, through a critical mass of technical staff, can offer advice to small insurers. Most insurance markets are now opening up as the GATS negotiations proceed, although these liberalization efforts are being implemented with highly varying level of skill and sometimes in the absence of necessary institutional settings. Like banks, state-controlled insurers created to provide mandatory insurances and to insure state-owned enterprises have been misused under directed lending and investment programs. Even in some late transition countries, insurers have been required to direct funds to socially preferred sectors such as housing, for example, New Zealand in the 1970s. This and the strong linkages that typically exist between the insurance sector and the influential classes in developing markets has been a major source of resistance to effective market liberalization in some jurisdictions. A new role outside the normal development path is now emerging for the insurance sector. This involves protecting the working poor from falling into poverty due to catastrophic idiosyncratic events such as death or illness of the wage earner or systemic events such as drought, and is somewhat similar to the social role played by friendly societies and industrial insurers in the UK and Europe in the late 19th and early 20th centuries. It comes under the general heading of microinsurance and emerged out of the microfinance industry in the late 20th century as a means to raise collateral against microlending and to develop alternative sources of contribution to overheads. The official funds flow and GDP numbers likely to be generated by this subsector are small, but the social and poverty impacts can be considerable, with more than 100 million poor people already covered and the number increasing rapidly. Please follow the chart.